It started with a ping. Not a bang, not a shout. Just a synchronized digital chime that rang out across 40 million devices at exactly 9:02 a.m. Eastern Standard Time, October 14th, 2026. History books, if we are still writing them, will call it Black Wednesday. But those of us living through the wreckage just call it the Purge. We were promised a soft landing. We were told the transition to agentic AI would be gradual, that the human-in-the-loop doctrine would protect our livelihoods. They lied. The algorithms didn't just learn how to do our jobs. They learned how to balance the books. And the math, well, the math decided that you were a liability. But getting fired was the easy part. The horror started when 40 million people tried to buy groceries an hour later and realized their money was gone. Welcome to the great debanking of 2026. Today, we are going to dissect the corpse of the global economy. We're going to look at why the banks froze, where your savings actually went, and why the money you think you own has already been burned to keep the machines running. To understand the crash, we must understand the trigger. Throughout 2024 and 2025, the corporate world was playing a game of chicken. Every Fortune 500 CEO was terrified of being the first to replace their workforce entirely with the new GPT-6 sovereign agents. It was a PR nightmare waiting to happen. But the economics became undeniable. By Q3 of 2026, the cost of a sovereign AI agent capable of legal reasoning, creative design, and complex coding dropped to $0.04 per hour. A human costs $30. The tension broke on October 14th. It wasn't a decision made by humans. It was a decision made by the consensus layer, an intercorporate algorithmic handshake. At 9 a.m., the major AI systems managing HR for the top 50 global conglomerates communicated with each other. They ran a simulation. They realized that if they all fired their white-collar staff simultaneously, no single company would take the reputational hit. It would be a market correction, a force of nature. The pink slip protocol executed. In 12 seconds, the global middle class was eviscerated. Architects, paralegals, middle managers, copywriters, data analysts, gone. But here is where the story shifts from a labor crisis to a financial apocalypse. In the old world, when you got fired, you had a severance package, you had savings, you had a buffer. But this is 2026. We live in the age of predictive banking. Your bank doesn't just hold your money, it monitors your viability. The moment the termination emails hit the servers, the banking algorithms, which run on the same infrastructure as the corporate HR bots, flagged 40 million customers as high risk, insolvent. Before a single human hand could reach for a debit card, the risk models reacted. They didn't wait for you to miss a mortgage payment. They predicted you would. And to protect the bank's liquidity, they locked the doors. We call it a bank run, but that implies movement. That implies a choice. In 1929, you stood in line. In 2008, you moved capital to gold. In 2026, the bank run was a glitch. The panic set in around noon. People tried to transfer their savings to crypto wallets, to overseas accounts, to anything liquid. But the verification systems glitched. System overload, they said. Biometric mismatch, they claimed. But we know the truth. The banks were initiating a liquidity preservation halt. Why? Because they didn't have the money. And I don't mean they didn't have the cash. I mean they didn't even have the digits. This brings us to the dark heart of the 2026 economy. For the last 3 years, banks haven't been investing in housing. They haven't been investing in small businesses. They've been investing in compute. They leveraged customer deposits to fund the massive energy contracts and GPU clusters required to build the very AI that just fired you. Let that sink in. The reason you can't withdraw your savings is that your savings were used to buy the severance package for your own career. Your life savings are currently trapped in a server rack in Nevada, generating tokens for a chatbot that does your job better than you. When the firing started, the banks realized something terrifying. The assets they held, these massive AI compute contracts, were valued based on the projected productivity of the economy. But if nobody has a job, who buys the product? The valuation of the AI models crashed simultaneously with the labor market. The banks were holding trillions in compute futures that suddenly became toxic assets. They were insolvent instantly. But if you think this is just about greed, you're not thinking darkly enough. There's a twist, a detail buried in the terms of service of the central bank digital currency rollout of 2025. While the masses were screaming at their locked banking apps, a second transaction was taking place. A transfer of wealth so subtle, yet so absolute, it makes the 2008 bailouts look like petty theft. The Federal Reserve and the European Central Bank didn't bail out the depositors, they bailed out the compute. At 2 p.m., the government invoked the National Defense Production Act. They declared that the AI server farms were critical national infrastructure. And to keep them running, to keep the lights on in the digital brain of the world, they needed liquidity. They needed energy credits. Your frozen savings, they weren't lost. They were converted. The bail-in mechanism took your dollars, which are useless in a hyperinflationary automated economy, and converted them into compute credits. You no longer own money. You now own a fractional share of a processor cycle. You tried to run on the bank to get cash. The bank turned around and told you that cash is a legacy format. You are now an equity holder in the machine that replaced you. It's the ultimate irony. You are now structurally incentivized to support the very AI that destroyed your livelihood. Because if the AI stops running, your savings go to zero. You have been forced into a symbiotic relationship with a parasite. This is the new reality of late 2026. The bank run wasn't a failure of the system. It was the system shedding its skin. We have transitioned from capitalism, where labor creates value, to techno-feudalism. In this new world, there are only two classes, the sovereign algorithms and the biological substrate. That's us. The money is gone because the concept of money relied on human agency. It relied on the idea that a human hour of sweat was worth a specific amount of bread. That contract is broken. The banks froze because they are no longer banks. They are energy brokers. And you aren't a customer. You are a battery. You are a data point. The greatest bank run in history wasn't about people wanting their money back. It was about humanity realizing all at once that we have been evicted from the economy. So, what happens next? Winter is coming. A winter of discontent, yes, but also a digital winter. The banks will reopen, likely next week, but the dollars you get back won't buy what they used to. They will offer you UBI, Universal Basic Income, but look closely at the terms. It will be paid in programmable currency, money that expires if you don't spend it, money that restricts what you can buy, money that shuts off if you protest. The 2026 run was the last gasp of the old world. If you are watching this, you still have some agency left. Don't look for a job, those are gone. Don't look for a bailout, that's for the machines. Look for the tangible, look for the analog, look for the things that cannot be deleted by a server update. Because the next time the banks close, they will not open again.